Hey, good morning, everyone. Welcome to the Macro Snapshot and the new week. We are Monday, January the 26th, 2026. Of course, this is Australia Day, a national holiday, so the Australian markets will be closed today. Yesterday, I did a sort of a fairly detailed overview of the macro situation and the macro context for the week. So this morning, I just want to focus on, just overnight price action and just generally what's going on in a specific market sense. So let's first of all look at the US dollar versus the JPY. So we all know that there was a lot of talk, which I spoke about in yesterday's video, about potential sort of joint intervention, verbal or not, by not only the authorities in Japan, so the Bank of Japan with the Ministry of Finance over in Japan, but also potentially the New York Fed operating maybe in conjunction with the Japanese authorities to rate check. So that means they sort of basically contact dealers and say, hey, how much would it cost to buy or sell? And essentially sending the market a little signal that there may be some kind of intervention happening. The market got spooked by that. So it was a key level. So obviously a lot of people were long. So, profit taking. So a pretty dramatic sort of fall in the US dollar versus the yen. And the yen actually strengthened overall, of course, against most cross pairs. So it was interesting because we got to this key level basically by Friday afternoon, about 155 and three quarters here. So then the question was, would there be any dip buying? Would there be further intervention? But in the low liquidity last night and rumors that the US Treasury, for reasons I'll get to in a second, and the US government is maybe not super happy with this incredibly weak yen. The market basically decided to sort of push that a little bit lower. So we broke quite a lot of technical resistance here. So this sort of uptrend line, which has been going back for a while, we gapped down and broke that. Tried to retest and failed. We then broke below the 50% fib retracement. So when I say the 50% fib retracement, I'm using as an anchor point the 17th of October. Of course, you could, potentially move that back a little bit. So let's say we say that this is actually maybe a more appropriate level or another potentially appropriate level. The point is here that we broke through a couple of key fib levels. Whether you call it the 38 or the 50%, basically we're now down at the 50%, which also is going back to a long-term sort of a resistance here. If you see this trend line here, so this is quite a key level here. And if we just also throw in a few moving averages, which I'll do right now, you can see that it's sort of the 100 EMA, not exactly, but the point is here, you've got some support. There's sort of horizontal support here, a bit of congestion. You also have this sort of downtrend line, which could be support. And you could also argue that it's the 50% fib retracement going back to actually maybe the 1st of October is a more appropriate level. So there was a little bit of a bounce there. So what happens now? I'm not sure. I mean, I think it's interesting to start a dip buying, but we may just want to see how the market shakes out for a few hours this morning. Now, why would the US authorities, potentially want to sort of see a stronger US dollar versus the US yen, or let's just say a weaker US dollar versus the yen? I alluded to some things yesterday, but just keep in mind, there's kind of maybe like three different reasons here. Like I remember that a weak yen adds to the JGB, so the Japanese government bond sell-offs. So of course, if you get a Japanese government bond selling off partly because of the weaker yen, you're going to get higher yields, and of course that's going to put some sort of a spillage effect onto US yields, which will go higher. And we know that Secretary Treasury Bessent and Trump are very, very focused at the moment on trying to keep yields on the long end low. They want lower interest rates for mortgages and things like that. So they absolutely are focused on having a lower 10 and 30-year yields. And so you see it's kind of this chain of reaction. So one way is to maybe sort of weaken the US dollar and strengthen the Japanese yen. Secondly, remember that the US has, at the moment, has tariffs on Japanese products, and so with this sort of very sort of weak Japanese yen, that is minimizing the effectiveness of some of these tariffs, and basically making Chinese exporters and Chinese manufacturers more competitive, not only compared to like the Chinese and other Asian sort of counterparts, but also in the US. So the point is that with a very weak sort of yen, that's not great for Trump's the effectiveness of Trump's tariffs. Then the other issue is, who knows? And again, I know nothing about this, but I'm just wondering whether behind the scenes, who knows, maybe the Chinese are a little bit unhappy, and maybe there was some sort of back channel thing between the Chinese and the Americans saying, hey, this we've got to stop with this sort of weak Japanese yen. Not great for Chinese manufacturing and not great for for US manufacturing, as I said. And if we actually look here, just keep an eye here on the Chinese yuan versus the Japanese yen. And you can see here, I mean, basically going back to, let's call it Liberation Day, sort of April, you can see here that the Chinese renminbi or the yuan has basically sort of strengthened very, very strongly against the Japanese currency. And of course, China's whole economy, in a certain sense, is built on competitive exports. And we know that they've been trying to flood the global market. But if you look at this has been making, if you look at this chart, this has been making the Japanese exporters much, much more competitive. So they're obviously unhappy. And I'm not saying this was part of it, because I have no evidence that China was in touch with the US sort of Fed or the Treasury, but who knows? Interesting, because obviously the renminbi is also weakened now against the yen, which is going to make their sort of exports more competitive. So a lot of stuff moving on there. And the other issue to keep on in mind here is this whole issue about the carry trade. And we know that the Japanese yen has been used as a funding currency. So I just want to give you a sense of that. I've got a little chart here which essentially shows here where are yeah, so you've got here, just picked this up from Bloomberg. So it's a US dollar Japanese yen carry trade. And you can see here that if you basically just borrowed in Japanese yen to fund your trade and went long US dollars, this is the kind of performance you would have had. So you see, it's been a pretty good trade, especially for the last, let's say, sort of 8 to 12 months or so. And so what we need to look out now is that as the volatility goes up and the Japanese yen starts to fall. So remember, I showed you the chart yesterday of volatility in the FX space going up. So volatility will pick up on these kind of moves. And remember that if you're a carry trader, what you want is a stable funding currency, and you also want a low volatile funding currency. So as soon as the volatility picks up and the funding currency starts to gain strength, that is not good for the carry trade. And so we might see some unwinds of that. So already starting to see some unwinds. And I just want to show you the chart here of the classic carry trade, which is actually buying or funding, where are we here? Here we go. So this is Mexican peso versus the Japanese yen. And you can see here that this has been one-way traffic. So basically you borrow in Japanese yen, which is a low volatility, stable, weakening currency. You buy equivalent government bonds or in the Japanese and the Mexican peso. And not only has the Mexican peso appreciated in value, which is great, but this has been one-way traffic here. So the problem now is that for people involved in this trade, you see, similar to with the Chinese renminbi, this has been reversed. So let's just see, it seems to be holding this sort of upper trend line more or less, and it's only back at the 20-day exponential moving average here. But the point is that these carry trades don't like volatility, and they certainly don't like the funding currency to be gaining in strength and volatility. So they tend to sort of unwind those relatively quickly, and that will then cause a repatriation back into the funding currency, which in this case is the Japanese yen. Now, other funding currencies are also potentially like the euro. So we might actually see quite a bit of money flooding back into the euro as well. So let's keep a lookout for some of these funding currencies as well, maybe even the Swiss franc. And you can see here just sort of generally, if we just look at which has been going on, we see overall dollar weakness, although we are starting to get down towards this pretty key support level. I mean, it's still quite a long way to go on the dollar index itself at about 96.28. But keep in mind, the dollar index does not include a lot of emerging market currencies, does not include the Chinese renminbi. So I was actually looking yesterday at the Bloomberg dollar index, which is a much more broadly based dollar index, and that's actually getting down towards multi-year lows. So the point is here is that the DXY, which is very Eurocentric, we've got the Swedish crown, the euro, obviously 58%, the British pound, a little bit of yen, a little bit of Canadian dollar, is not actually as weak as the broad dollar index. And you can get a sense of that if you look, I've been showing some of these charts, like you look at the US dollar versus South African rand. Even with all this chaos, look, the US dollar has zero sort of safe haven bids and is continuing to weaken against the South African rand. We just, if we look at the Brazilian real, the US dollar also down at lows. You get the picture here. So the US dollar against emerging markets, very, very weak, sort of in general. And now, just getting back to some of these majors, if you look at the euro, you can see here that it's almost sort of peaking out around about the 119, which is overhead resistance. As I say, that'd be benefiting from sort of this carry trade money coming in, but it looks like it's just everything sort of just cooling off a little bit. We look at the Swiss franc, we can see the US dollar, the US dollar having a little bit of a bounce this morning, but basically Swiss franc breaking pretty key levels here. If you look at something like the US dollar versus the Swedish krona, you can see that that broke also key levels and now just finishing off a measured move. So this is strength in the krona versus the US dollar. And again, it comes down a little bit to this sort of debasement story, a fiscal responsibility story. And talking about fiscal responsibility, just moving off, I mean, just one of the issues here as well. Keep about the thing about the US dollar is that imagine if you're a non-US holder of bonds or stocks. So we're continuing to see flows into the US of people buying, or when I say people, foreigners buying bonds and buying stocks. But if you're not hedged, if you're not currency hedged, remember that your returns in the SPY, in NASDAQ, in the Russell, and even your sort of a coupon, sort of a yield income from your holdings of bonds in the US, if you're getting a US dollar, and let's just look here, if you're getting a US dollar, which if you go back, let's say, from 1 year ago, look at this. I mean, the US dollar basically, hold on, let's just do this, going back to February of 25. So literally 1 year ago, all of your returns, so your total return denominated in US dollars, you're talking now about 12% loss. So the point here, what's the point I'm trying to make here, is that you have to look at the US dollar not only just as its exchange rate, but also it's the source, it's the denomination, the denominated currency of income and returns for non-US holders of bonds and equities and any investment in the US. So the question is, if you're seeing this sort of weakness in the US dollar and lack of stability and volatility, if you're one of these foreigners, you want to be starting to hedge more. So it means not only, let's say, for example, you own a chunk of the SPY, SP 500, you're saying, okay, my returns, my dividends are coming in US dollars. That seems to be weakening 12% over the last 12 months. I need to be hedging that. So if you're hedging that, you're starting to sell. So my point being is that increased hedging demands will have a structural dampener on US dollar strength. That's the point I'm trying to make. Now, can you trade this on a daily basis? No. But what it's saying is just another factor apart from fiscal irresponsibility, debasement, blah, 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 all of those other big macro factors. Increased hedging demands are going to put a little bit of extra sort of a weakness into the US dollar from a structural point of view. Okay, so let's just go into a few other markets. Enough there of the FX. We'll keep an eye on everything over there. So let's just go back into some of our other charts. Having said all that, so let's just see how volatility goes. There was a little bit of a sell-off in the equities and the overnight gap, but that was sort of soon refilled. But if we just look at equities, sort of volatility in general, you can see the VIX here, still at relatively low levels. But maybe even more importantly, if we look at the bond volatility, the MOVE index, that's down at low levels. The TLT VIX moving up a little bit on Friday, but not too bad, still off its highest level. So this is relatively positive for the equity space. And if we look at the S&P 500 here, you can see as I said, there was a little bit of a gap down, just a sort of a bit of concerns about the Japanese yen situation, but that's subsequently been brought up. And of course, we're going into the big earnings season, which I mentioned yesterday. We've obviously got Microsoft, Meta, Tesla, Apple, Visa, Caterpillar, all kinds of companies happening midweek, apart from the Fed. And if we consider that a lot of these sort of tech companies are doing very, very well, and the broader indices are sort of are gaining in strength, no reason here why slightly weaker US dollar is not actually at a certain point a little bit beneficial to the stock market. So we're getting this paradoxical situation that we're getting flows into the US to buy the stocks, but maybe the US dollar itself is weakening a little bit. Now, in terms of just the general flows, we see the ES, it looks as though it may want to do a bit of a run now. Has had a nice sort of fib retracement here, maybe wants to run at all-time highs. As I say, we've got the tech earnings this week. The tech has been underperforming a little bit. It looks as though it may want to break out of this big sort of consolidating triangle here. See this big consolidating triangle and at least push to local highs, if not all-time highs, maybe up to 26,000 or so. But really the story has been there generally. I mean, we had a bit of a sell-off on Friday, but essentially we've seen that the small caps, things like sort of value is outperforming. We're seeing that the semiconductors is outperforming the broader tech space. So general strengths. But what is interesting, I just found a nice little chart here, is just to see that this sort of move into small caps is actually not only in the US, but it's also global. So if we have a look here and look at the Russell 2000 relative to the Russell Top 50, divided by the MSCI World Small Cap relative to the MSCI World. So basically, this is basically sort of the Russell Small Cap versus the large cap, and also on the global one. And you can see here that they're both doing very, very, very well. Not only in the Russell, but also broadly globally. So what I'm trying to say is that this whole sort of rotation trade, there's all these rotations, US a little bit to non-US, also sort of developed markets to emerging markets, but also sort of momentum to value, and also large cap to small cap. This is really all these things. So this is what we have to be looking out for also this week. But that's an interesting chart to keep an eye out on there. Okay, so the other thing to be looking at, oil had a little bit of a boost. Have a quick look at oil and some of the energy. If we look at oil, we can see it had a little bit of a boost, doing quite well. I don't know. I mean, it's an interesting one. It looks like OPEC's not going to increase their output, but really, I think what got the market's attention a little bit over the weekend caused a little pop. Trump continues to say that a massive armada, the Navy, the ships are sailing towards the Middle East and Iran. I mean, is he going to sort of launch some kind of strike on Iran? It depends how desperate he is. We know that domestically, there's issues with what's going on in Minnesota and whatnot. So I think the oil market is keeping a little bit an eye of that sort of flotilla, that sort of huge armada which is sailing towards sort of the Gulf states. Let's keep an eye on that, and maybe that's keeping a little bit of a bid underneath oil. What is interesting, we all know there's freezing weather across North America in general, and you see here that nat gas. Boom, boom, drum roll. Look at that. Another gap higher. Now going pretty crazy here. Although, is it crazy? I mean, it stopped at this level here, which you can see is a level from March of 2025 at about 6.25. Is it got more to go? I don't know. I think it's going to depend on the weather. Certainly, if the weather calms down a little bit, we have to keep an eye on the weather forecasts, the weather updates. For sure this will come up. On the other hand, if the weather keeps on freezing, maybe this can sort of pop a little bit higher, because for sure liquidity up here is going to be quite thin. There's going to be a lot of shorts who are going to be stopped out. We're going to get a little bit of a short squeeze, but it's going to be weather dependent. If we get colder weather continuing, can this sort of cause a little bit of a short squeeze and a stop run above? Absolutely. If the weather does start to calm down, is there a scope here for a big reversal? Absolutely. So I think it's going to be weather sort of dependent. Let's keep an eye on that. You also see over. So the point is that nat gas is being in demand, not only cold weather in the US, but also across Asia, Northern Asia, and also in Europe. And you see here the TTF sort of benchmark contract over in Holland is, you see the TTF contract also pushing very, very high as well. So not only the US, and of course, if you have Europe, Northern Asia, and the US sucking in sort of nat gas, that's putting pressure on LNG prices globally, which of course is causing a squeeze in the prices. So a good moment to be long sort of gas, LNG, these kind of things. Other thing we just want to finish off here, guys, obviously is the metal space. So let's have a look at gold. Boom, there you go. Now, as I say, of course, it's overextended from, RSIs and all this kind of stuff. Is it overextended in terms of the Bollinger Bands? Yes, it is. Actually, let's throw in some Bollinger Bands just because they're fun. If you look at the Bollinger Bands, you can see, it's quite rare on the daily Bollinger Bands for the metals in general to close outside them. But what you can see here, the last 3 or 4, 5 days, we're starting to close and really extend the Bollinger Bands. So, is it overextended on the stochastics, the RSI, the Bollinger Bands? Obviously, yes, it is. But what's also kind of interesting, I just saw a chart this morning on gold. If you actually look at the speculative futures traders, like on the CFTC, the Commitment of Traders report, which comes out on Friday afternoon, that's actually calming down. Speculators in terms of futures are not actually that long gold. Secondly, ETFs in the West, so things like GLD, the inflows are actually relatively contained. There is not really a speculative bubble coming from futures traders or from ETF inflows. So you've got to say, where is this demand for gold coming from? And this is the spot price here. As I keep on trying to say, the demand is ferocious in India, Brazil, China. Chinese real estate has gone down average, depending who you read and believe, 10, 15, 20, 25, 30% over the last few years. The average Chinese home and apartment. Most Chinese people with spare cash did put it into the real estate market over the last 5, 10, 15 years. Imagine you have hundreds of millions of people's their investment eggs are basically down 20 or 30% because of real estate markets. These people are looking for a store of value. It's difficult for them to buy crypto. They're like, hey, where can we put the money? There's 5,000 years of tradition and history in buying precious metals. Let's put it into silver and gold. There is a huge retail demand happening for silver and gold in India, China, Brazil, Iran, Turkey, these kind of countries. So my point being, I should have got the chart. I'll maybe show it tomorrow. As I say, ETF inflows are relatively limited in Western-based ETFs, and also the speculative position for the commitment of traders sort of reports in terms of futures is actually not that overextended. The overextension is retail sort of bubble buying. Is it a bubble though? Hey, if my investment apartments were down 30%, I'd be stressing as well. Anyway, there we are. It's overextended, but can the measured moves continue? Yes, this is what I'm trying to say. If you look at something like this, the measured moves can keep on going. At this point, and it's a very similar situation. Let's have a look over in silver. This is the silver futures. There we are. So we're talking, last Thursday, it's like, oh, it's an obvious short. It's overextended. Boom on Friday. Boom today. It's risky. It's difficult. And again, if you look at the measured moves, exactly the same situation. It's above it's overextended on the RSI, on the stochastics, on the Bollinger Bands. We get it. It's pretty obvious. But as I was trying to say here, what is interesting, silver compared to gold, there have actually been, as I was saying in yesterday's videos, two, if not three sideways consolidations here. Look, consolidation, mini consolidation, mini sell-off, and consolidation. Silver is not as overextended technically as it may first appear. I mean, is it overextended? Absolutely yes. But one could argue that a little bit of froth has been taken out of the market on three mini occasions, let's call it, over the last 2 or 3 weeks. Hey, are you going long here? Probably that's a fool's errand. To short, for sure, it's an interesting looking short. But as we pointed out before, volatility. If we just go back to volatility, look at silver volatility. There's your silver volatility, almost at all-time highs. Very, very expensive to buy to be long gamma here. So you want to be doing spreads. Let's just put it that way, like a long put spread or something like that. Maybe with a 2, 3, 4, 5 week time horizon. Finally, guys, just want to have a look at copper. Just want to show you a little bit of a copper, sort of a structural chart here, just to finish off here. If you look at copper, copper, here's the point here. This is something I pulled from Bloomberg Intelligence. So if you look at the primary supply, which is this big blue boxes here, if you look out for the next, let's say, 5 years, you see that according to the Bloomberg Intelligence Unit, there's not going to be forecast any massive increase in supply. Copper mines are very difficult to organize, to find, to fund, to bring online. We're talking 5, 10, 15-year and billions of dollars lead time and lead investment. This is an expensive, complex, slow business. You don't just turn the tap and go, oh, let's get some new copper. We all know the demand for electrical grids, AI data centers, electric cars, batteries, all of this stuff. There's going to be increasing structural demand for copper. You see here this turquoise number. You see the turquoise line going up. So gradually going up. Now you say, what about secondary supply? So secondary supply, as they say here, includes scrap, battery recycling. Yeah, for sure, there's some of it, but it's not really increasing. Bottom line, copper is structurally bullish. Now, can you trade this day to day with a chart like this? No, you can't. But this is why I think if you go back and look at the copper market, for sure there's going to be stuff about tariffs and China tariffs and this and that. But the point is that we're starting to get to a situation of copper where a lot of dips are being bought. Now, unlike its cousins in the precious metal space, look at the Bollinger Bands, not at all overextended. You see copper overextended, reached resistance, it sells off, gets bought the Fibonacci. Copper gets overextended on the Bollinger Bands, it gets to overhead resistance. What happens? It sells off and the dip is bought on, good levels, Bollinger Bands. So we're getting a situation here in copper that it's just grinding higher. When it does get overextended outside the Bollinger Bands on the dailies, It's coming back to good resistance points, Fibonacci levels. Boom, boom, boom. Here we go. So it looks as though copper wants to push. Let's just call it to local highs at 6.12. That's going to be an interesting level. Again, this is the US copper market, but it's still got a bit of juice, 2%, 250 ticks, $12.50 a tick. That's a nice one. By the way, sorry, I forgot to say, just getting back to silver very quickly here, just to finish off here. Um, uh, that in the premium of silver selling in the Shanghai exchanges versus London and New York exchanges is extreme. And again, I didn't show the chart, but if you look at the premium of silver selling in Shanghai versus London and COMEX and New York, there's an extreme sort of premium there. And that's because the flows going China, there's huge demand. So again, this whole idea that there's a lot of demand coming out of East Asia, just keep an eye on that. Okay, finally, guys, for BTC, and again, this is not an ideological comment, it's simply a technical analysis comment. You see the BTC really failing pathetically. It failed this little fib retracement here. Couldn't even get it to 38%. Again, I do highlight the fact that this level down here at about 86,500 does seem to be fairly critical. BTC is getting to the slightly getting towards the bottom of the Bollinger Bands as well. So, could we see a little bit of a shakeout just down here to maybe 85,000 or so? Possibly, but I do think that that represents quite good value, at least quite good risk reward to maybe load up a little bit average cost basis, averaging down on the BTC holdings down here. That's quite an interesting one. Although the bears could say that maybe this whole formation here, if you look at this, is this potentially some kind of bull flag. Hold on, let me put a big fat crayon on this. Where's my fat crayon? Oh, there we go. Not really a fat crayon, a thin crayon. But one could argue that we are getting into a sort of a bear flag possibility. I don't know. It's not a perfect bear flag, because the perfect bear flag would probably be something like that, which actually is sort of broken. So maybe it was a bear flag and is breaking the bear flag. Point is, we're at a fairly critical level here. Bottom of the Bollinger Bands, horizontal support. I think BTC really has to hold within the next 2 or 3,000 here. Otherwise, there could be a bit more of a flush downwards. And what could that flush downwards look like? Again, if we look at a Fibonacci extension here on relatively short term, you see anchoring from the 14th of January, kaboom, the Fibonacci extension would lead to this low from the 20th of November down at about 80,000 or so. So if it flushes down here, technically there's no reason why it can't go down to 80,000. We'll see what happens over the next few days. Okay, guys, going to leave it there. Have a great trading day. Obviously, everyone's going to be looking at the yen. Not a huge amount of data or action happening. We do have a durable goods happening at 8:30, although that is from November, so it's getting a bit stale. We do have the start of the bond auction cycle today. We have a 2-year. That will probably go quite well, but it's always interesting to look at those when people are talking about other stuff. Have a great day, and we'll be back tomorrow with the macro snapshot. Thank you very much. Goodbye.